All right, everyone. Well, it's July. I can't believe it's July. This year flies by. It seems like January is about 52 days long, and then July takes about 4 days, and always seems to go that way. So, welcome. Thanks for joining us for our monthly markets and economy update. You'll see there are three of us here, so we're going to have one of our tax planning and financial planning experts, Adam, share some of his insight. But before we get there, I'm Jarrod Musick. I'm the CEO here at Destiny Capital. I sit on the investment committee along with Tim, so really in a thought partnership role as he leads us on all of our investment management, portfolio management, and then I also work closely with Adam on our client planning and individual client strategies. So definitely a thought partner there as well. Tim?
Yep, my name is, thanks, Jarrod. My name is Tim Doyle. I'm the Chief Investment Officer here at Destiny Capital. I handle and oversee all things related to investments. That includes capital market research, fund due diligence, manager selection, portfolio construction, trading, and more. And I also collaborate heavily with our client service teams, and Adam Burch is one of those as our Senior Client Wealth Strategist. So Adam, why don't you go ahead and introduce yourself as well?
Yep. Thanks, Tim. Adam Burch. I'm a senior client wealth strategist, working directly with many of our clients, also working with all of our client service teams to make sure that we are providing a consistent financial planning and client service model across the board.
Awesome. Before we dive into all the goodies, do have to go through all the disclosures here. So Tim and I are both officers of Destiny Capital. We have made every effort to make sure the information that we're sharing with you today is accurate and timely. There's the possibility that we made errors. We don't think so, but always the possibility. So if you already work with us, reach out to your client service team, reach out to your advisors, whoever here that you want to talk to before you make any decisions based on what we talk about today. If you don't work with us, talk to your advisor, CPA, tax attorney, somebody who really knows your situation and can help you make good decisions. We're not going to talk about individual securities today, but frequently on this webinar, we do talk about them. And sometimes we maintain positions in those securities. And then Destiny Capital is a registered investment advisor. So onward we go. And the reason that we have Adam on with us today, as you may have heard, we had a little bit of a tax bill come through, just a small thing. And lots of questions, lots of provisions, lots of changes. So we wanted to talk about the tax bill in the context of both, what does this mean for investments and markets, and what are we looking at? And then also, what does it mean for individual client planning, and answer some of the top questions that we've had as this has gotten enacted here within the past few weeks. So we're just going to refer to this as the tax bill because it's quite a mouthful and there's no consistent acronym. So some of the key provisions here, Adam, do you want to go ahead and kick us off and talk about some of the key provisions that we've seen from the tax bill?
Yeah, sure. So there is a lot in this bill. Some changes are permanent, at least until Congress votes to change tax law again. Other provisions are set to expire within a few years. And that's for various reasons, budget reconciliation rules or compromise made during negotiations. But really, some of the primary provisions are that the standard deduction has been made. The higher standard deduction has been made permanent, and it's set to increase with inflation. So when the Tax Cuts and Jobs Act went into effect in 2018, you probably remember that the standard deduction nearly doubled, and so that higher deduction has just been made permanent going forward. Another key provision, one that we've seen a lot of our clients interested in learning about, is the over 65 bonus or enhanced deduction. I think it'll actually be called the enhanced deduction on tax returns. But so with that deduction, seniors over 65 can qualify for up to a $6,000 additional deduction for single filers or $12,000 for joint filers on top of the standard deduction or the itemized deduction. It's completely separate from those things. It does phase out with higher levels of income, but that's one of the things that we've seen is going to benefit many of our clients starting this year. So I mean, we're less than a month into this, but we've been running some tax projections side by side with the new law and then the prior law, and that is something that is looking like it's going to help clients. Another major change, I think, that will benefit a lot of clients or tax filers particularly in states with high income taxes or high property taxes, is the state and local tax deduction increasing from what has been $10,000 cap since the Tax Cuts and Jobs Act was passed. That's now increasing to $40,000, and again, that phases out at much higher levels of income. I believe between $500,000 to $600,000 of income that starts to phase out. But so whether it's state income taxes, property tax, sales tax, that cap for the deduction on your Schedule A, your list of itemized deductions, is now $40,000, and I think that will help us. For a lot of clients who have maybe not been able to itemize because their property taxes or state income taxes have been capped, I think that will help, and it'll give us a lot of opportunities to help clients optimize charitable giving, things that they really haven't received much of a tax benefit for over the last several years. So I think that will be really helpful. Another couple, maybe not as impactful provisions, but still important. So the child tax credit, it has been $2,000. Now that's being raised to $2,200 and will be inflation adjusted going forward. So it'll increase over time. And then educator expenses, those have been kind of a small deduction. I think the limit was about $300, and it was listed as an unreimbursed employee expense on tax returns here in the last few years. That can now be added to itemized deductions with no limit. So for those taxpayers who are teachers or coaches or someone involved in education, there's the potential for that to be a significant benefit.
Mm-hmm.
And I have a quick question, if I could insert here. I just had a quick question about when we talk about inflation adjustments as it relates to these provisions. Do we know what that's tied to? Do we know if that's tied to CPI or PCE? Do we have a sense for that, or is that still kind of an unknown at this point? CPI tends to be higher than PCE, so that's the Fed prefers PCE, so that might be an excuse to choose the lower threshold there more consistently. So yeah, just curious if you guys were aware of anything as to what that's pegged to.
Yeah, no, I have not seen a specific measure outlined. So it'll be interesting to see how they how that looks going forward.
Yeah.
That's probably at Treasury discretion. I would imagine that they can select. I haven't looked at the exact language in the bill, but it's probably, hey, pick an appropriate inflation metric and utilize it to calculate this. So I think that's a great call, Tim, because that can make a difference, maybe 0.5% or 0.75%, something in there for sure. One call out that I had just looking at these is, the state and local tax or SALT deduction cap. That's obviously a big one, whether you're, like Tim and in New Jersey, and there's very high income tax rates, or you're like Adam and you're in Texas, and very high property tax rates. Those start to get material. But there's also, for owners of pass-through businesses, that was one of the major negotiating elements that we saw in the workup to this final bill. Is something called pass-through tax entity tax treatment, where a business can pay those state level taxes to be able to work around that $10,000 cap. So those were actually left in place in the final version, correct? They had been negotiated whether that tax structure would be allowable or not, and it looks like it remained.
Yep, that's right.
So if you own a pass-through entity, that pass-through tax entity tax treatment, PTET, is still a viable planning tool for sure. Yeah. Well, I think, moving on to the next one, Tim, I'd love to hear you talk about kind of changes to the marginal tax brackets, and then how markets are really looking at that kind of in the early days after passage of the bill.
Yeah, I mean, when you talk about marginal tax brackets, we're not seeing anything change, right? But we're not seeing the old or the tax Cuts and Job Act tax brackets rise back to the pre-Tax Cuts and Jobs Act levels. So essentially, that keeps more money in the pockets of consumers, investors, and so forth. So when we think about the short term, we look at tax cuts and a tax bill and tax stimulus as something that's, in the short term at least, could grow the economy. And that's the hope, of course, of the Trump administration. So we could see markets on a little bit of a sugar high, I would say. And we have seen that in recent months since the markets bottomed out in early April of 2025. They have done nothing really but ascend since then. And that a lot of that has been in the hopes that this tax bill will get passed, and it has. And therefore, we see a lot of market optimism. So that's a good thing for investors. We're seeing valuations rise. We're seeing the S&P 500 valuations, the forward PEs of the S&P 500 getting a little bit expensive at 22 times, so 22x. So something to be mindful of. Markets are getting, as we say in the industry, getting a little bit frothy at this point, but we're entering a really key earnings season. So we'll see if earnings can really keep up with the valuations that we're seeing. When we look at a longer term, when we're talking about tax cuts, we're looking at the effect on deficit spending in the United States, right? So our federal government runs at a deficit. We spend more than we take in revenues. And when you're cutting taxes, you're cutting a source of revenue, the primary source of revenue for the government. And from this bill, the Congressional Budget Office expects that this will add $3.4 trillion to the deficit over the next 10 years. So what does that mean for the long term? That's going to have particularly bond market investors looking at that heavily to see if the fiscal health of the United States remains intact. We often refer to short-term bonds, short-term treasuries as risk-free. And if the United States deficit gets out of hand and debt spending continues to balloon, that perception of the U.S. As a safe haven asset could come under fire and could become questioned. We're not talking in the next 1 or 2 or 3 years, but down the line, that could be a concern that investors are looking at. So short term, we look at tax cuts as a good thing, as stimulative, as something that should grow the economy. And then in the long term, we're more concerned about deficit spending and what that means for the ballooning public debt in the United States and how that could be perceived by global bond investors. So those are 2 key areas that we're really paying attention to.
Yeah, absolutely. Well, and you can see in the 2 tables that we have listed here, the green text highlights what changed from tax law that's been in place since 2018 versus what was just enacted. And the changes are very small. So I think to Tim's point, kind of what your marginal tax brackets and rates have looked like is still going to be the case going forward. Adam, can you talk a little bit about, this new charitable deduction for non-itemizers, and then just, maybe some broad thoughts for our clients about charitable planning that we're thinking about going into this new tax environment?
Yeah, so when the standard deduction was nearly doubled with the passage of the Tax Cuts and Jobs Act in 2018, I believe the number of households that itemized their deductions went from around 30% down to just a little under 10% of households. So what that meant was that many taxpayers who had received a benefit for charitable giving, a tax benefit for their charitable gifts, were no longer able to get that benefit because it wasn't worth itemizing. The standard deduction was higher. So that's been something that we've been aware of for several years now, trying to find ways for clients to receive a tax benefit or given or at least making sure that they are giving in the most tax efficient way possible. And while we will continue to do that, but this new charitable deduction, there's a new charitable deduction now with this new bill that allows even taxpayers who are not able to itemize to deduct up to $1,000 for single filers, or up to $2,000 for joint filers who are not itemizing. So those numbers may not be gigantic, but it is definitely a benefit for those who really value giving and also like to see a tax benefit where possible. And of course, we'll be with a combination of these provisions, like the SALT cap deduction being increased to $40,000, that does allow more taxpayers to itemize. I think the last number I saw was that uh, economists expect now about 20% of households to be able to itemize, just based on that SALT limit increase. So there will be other opportunities to receive benefits for charitable giving, and those are always things that we're looking for anyway, because we do have many clients who like to give. So,
Yeah, absolutely.
and then a couple of the things I wanted to touch on
Oh
real
yeah.
quickly. I don't think we really hit on it very much, but a few kind of temporary new deductions are, and we've received questions about this, and there's a lot in the news about this right now, but with qualified tips, so you can deduct up to $25,000 from your income for income that you received from tips. And so the IRS still is still planning to release a list of what those occupations are that will qualify for that. But what they've said so far is that you must work in an occupation that has traditionally received income from tips prior to 2025. So businesses will not just be able to say, oh, we're not going to charge you anything for this. You can just give us a
Yeah.
$100 tip, and
Your oil
we'll
change
call
is
it
now
good.
$5, but a
Right.
25% tip, or a $25
Mandatory
tip
tip.
would be
Yeah.
recommended. Yeah.
Right. So there's still more guidance coming from that, but I think that will help a lot of taxpayers. The other is a deduction for overtime income, which can be up to $12,500 for single filers, up to $25,000 for joint filers. And then another one that has been in the news lately is up to $10,000 a year can be deducted for auto loan interest on new vehicles that are assembled in the United States. And that is starting with any new loan after 2024.
Yeah. So it's one of the provisions which is retroactive back to the beginning of the year. But
Right.
you need to know that yes, it was a US assembled car made with 70% US originated components, right? So
Yeah.
I think as we've gone through all of this, your taxes are not getting easier. The fantasy of filing your
Yes.
taxes on a postcard, which was talked about in the mid 20 teens, it's gone.
Long gone. Yeah, long gone.
Yep.
This is getting more complicated. And for things like that, and as you said, with qualified tips, like we're going to be waiting on IRS guidance on who qualifies and how would we know that somebody qualifies. For the US made cars, there's probably going to be something that the dealership will be able to tell you, like, hey, this particular model qualifies, this one does not, so that you can
Mm-hmm.
incorporate that into your decision making around vehicle purchases. So trying to not sound frustrated here, but this did not make our lives and taxes easier with this bill.
Right.
Yeah. Tim, I would love for you to talk about thinking about some of the business and estate tax changes and, what that might mean from an investment perspective as far as if you're planning as an individual investor around estate tax, or thinking about business owners and QBI deduction, just what happened and what changed for business owners.
We're gonna have to pause it there, Jarrod. I'm not the expert on this, so I'm not. Yeah, I don't know enough about it to chat logically. So we'll have to redo this portion of it because I don't. Yeah, I mean, the ties to investments are kind of loose. I would say. I don't know how that would tie into investment strategy specifically. Um, so
Here.
I don't know. Yeah, I mean, I'd
Yeah, I
love
was
to
trying to
talk.
tee you up so that this wasn't too much about him in a row.
Yeah.
All right, Carissa, if we can go back and start from here. Let's start this over. Three,
Sorry.
two,
I'm
one.
sorry. I apologize. I should know it all, but not in
No, no, you're good. That was
the
my
planning
fault.
chair that often. So
Yeah, all good. All right, we're restarting. Three, two, one. Okay, so as we move on to, thinking about business and estate tax changes, I'd like to talk about Just a couple of these areas. So the qualified business income deduction, it's extended. It was intended to be sunset at the end of this year, December 31st. That's now been extended into the following year and going forward. And the phase outs have been increased, meaning that you'll be able, as a qualified business, to be able to apply this deduction to a larger amount of total income before it being phased out. So there's still a number of businesses, quite frankly, like ours, that do not qualify because we're a service business. But that's a really big benefit for a lot of small businesses. That's broadly positive. And if we think about this from an economic impact, that's really an area where small businesses being able to potentially hire more people, invest in more equipment, technology, other things like that, we look at that as being broadly stimulative. Similarly, the estate tax exemption, raising that to $15 million per person or $30 million per household and adjusting that for inflation, it removes a large degree of uncertainty, where a lot of advanced estate planning may have needed to happen for a larger percentage of households because they were looking at a very large estate tax, potentially in the next few years. Now they're not. I think we're going to see about 0.5% of households actually need to worry about estate taxes going forward. The rest, it's no longer an issue. So a lot of these very costly, very involved estate planning provisions and structures that are put in place are not going to be needed going forward. And it also means that some of the things where you might have to sell more assets as one generation passes and assets transition to the next are not going to be in there. So these are kind of things around the edges from an investment standpoint that do matter, and they really do make a difference. So we definitely wanted to touch on them. Adam, any other add-ons for QBI or estate?
No, I think you pretty much hit it all. I mean, I think not a lot is changing with the qualified business income deduction. It's just really an extension of what we've seen. So not a lot of changes there from the estate tax exemption standpoint. That is something we've been watching just because, without the extension of that exemption, it was set to revert back to 2017 levels, adjusted for inflation, of course. But that would have dropped the exemption somewhere to around 5.5 to 6 million. So which would have impacted many more families in America. I think you're right. I think it's probably 1% or less of U.S. households have a net worth of 30 million or more, but significantly more of those have a net worth of 10 million. So
Mhm. And some things you wouldn't normally think about, right? So small businesses that are valuable, but they're not liquid. It's not like they would have had, $15 million of cash sitting there. It forces a small business to do more of this estate planning, purchase more insurance, perhaps set aside assets and cash to be able to pay a tax bill that they no longer have to. Agricultural properties, ranches, farms, things like that, where the land value is appreciated significantly, or water rights or things like that. So, I think broadly the estate tax it doesn't raise a whole lot of revenue for the government, and it's a big pain in the butt for taxpayers to try and work around. So that's actually a positive provision coming out of this. Tim, were you going to
Jarrod,
add something
if you
else?
think about the QBI provision, you could see tipping over some dominoes how that might impact monetary policy even. So if a provision like this boosts the labor market in aggregate enough where there's enough hiring, that could help solve one of the issues that the Fed is perpetually trying to solve, which is full employment, keeping enough people into jobs. That's one of the primary tenets. So if this helps to boost the labor market, the Fed may be less likely to lower interest rates in order to stimulate the economy moving forward. So you could see in a situation like that where changes to the tax code can actually impact down the line monetary policy decisions. And we all know we're seeing a lot of calls for lower interest rates moving forward. But if the labor market isn't demanding it, and if inflation's high enough, the Fed doesn't have the impetus, or it won't have the desire to lower interest rates, because that would defeat the purpose of what lower interest rates are intended to do. So just to tie into to think about of how fiscal policy can tie into monetary policy, and then how that can impact investors overall.
Yeah, absolutely. Well, and the last one on here, Adam, right after this passed, I got an email that said 90% of Social Security is no longer taxed. That's right, isn't it?
Yeah, I got the email too. I think we probably all did. Yeah, that is false. And this is probably the area that we've received the most questions on. So many clients have been curious about this. So yeah, Social Security Administration sent out an email a few weeks ago, like Jarrod said, saying that nearly 90% of Social Security recipients would no longer pay taxes on their benefits. The interesting thing about this bill is that it changed absolutely nothing relative to Social Security benefits or taxation. There was nothing in the bill that changed any of those things. So that email was a bit misleading because it really implied that the bill did make changes to Social Security. But what it did was something we already talked about, that over 65 bonus deduction really helped a lot of taxpayers who were already on Social Security. It's not directly tied to Social Security in any way. It has nothing to do with who's filed and who hasn't. But that is the deduction that is helping to sort of offset the taxes from Social Security. Of course, Social Security is not taxed that much differently than any other ordinary income. So overall, it did lower, taxes for most filers over 65. But in reality, about 2/3 of Social Security recipients already did not pay taxes on Social Security because their income was so low already. So nothing changes with Social Security. It's still taxed the same way, but the other deductions and other provisions of this bill do tend to lower taxes for most taxpayers.
Yep. Very confusing, which again returns to our theme of this does not make your life simpler or easier. But
Right.
we're trying to share. Unfortunately, Social Security benefits are still taxed as ordinary income.
Right.
Last couple provisions here as we wrap up. These are not major in most of our planning. They're not major in what's really going to move markets. But we did want to touch on a few of them. So, Adam, do you want to walk us through some of the education and child
Yes.
savings components that are in this bill?
Sure. Yeah. So previously, up to $10,000 per year could be used from a 529 plan for K through 12 expenses. That limit's been increased now to $20,000, and it's now available for, in addition to public and private schools, religious schools now qualify, and homeschool expenses qualify. So that'll be beneficial for families who have children in all different sorts of education settings. There is something now called a Trump account. We don't know much about how that's going to look in practice, but and this actually doesn't start until 2026. I think there are some logistics that need to be worked out with account custodians and things like that. But from what we know, it will behave similarly to an IRA, and whether it's a parent or any other individual can contribute up to $5,000 per year to a new Trump account. Those contributions are not tax deductible. And for newborns, the government will include a $1,000 initial contribution. You can contribute from birth all the way through age 17. At that point, the account becomes the beneficiary's asset. They can take the money out at that point if they want, although it would be subject to early withdrawal penalties. Like I said, it sounds like it will act a lot like an IRA in that you need to wait until at least age 59 and a half to take those funds out without a penalty. So, and it's really intended, I think, to just set up savings for younger people and give you a really long runway to be able to save for your children or grandchildren or anyone else. And the big benefit here is that there are no income requirements for beneficiaries, unlike an IRA or Roth IRA, to be able to contribute to one of those accounts today for a child of yours. They need to have earnings, some sort of income to be able to contribute. That will not be the case with these new types of accounts.
Yeah. lots more details to come,
Yeah.
like a lot of this. And so we'll be sure to talk with you all about that going forward as we get guidance from the IRS and Treasury and whoever else is involved in setting these accounts up and how they're actually going to work. One just comment on the 529 plans. There's a lot of state level sort of independence on how they choose to allow or not allow provisions of that, which was already the case with K through 12 expenses being able to be utilized from 529 plans. There are some national plans, but in general, 529 plans are originated and sort of sponsored by the state. And some of those plans, like the Virginia plan, you can participate in the Virginia plan if you're not a Virginia resident. In some other states, they're very specific to that individual state, and they've chosen to allow or not allow K through 12 expenses. And so we certainly anticipate, religious and homeschool expenses being something that is a state by state process, and certain states will allow it and certain others won't. So again, we'll keep you up to date on that as we get more guidance. Last couple here, and then I would love for us to wrap up. I know there's a lot of detail, but I would love for us to sum up. So, can you talk about, Adam, again, some of the clean energy credits that dates changed?
Yeah. So all of these clean energy credits that have been in place for quite a while now are going to be eliminated at some point in the next year. And so you can see they all have different expiration dates here. So like the electric vehicle credit, which previously was $7,500 for a new electric vehicle, or I think $4,000 for a used one. That is set to expire for any vehicles purchased after September 30th of this year. So that's totally going away. Similarly, for any sort of energy efficient home improvements, solar panels is a popular item that we see with this deduction. That's going away, or this credit, sorry. That's going away at the end of the year. So any property placed into service after December 31st of this year will not qualify for that credit. And then lastly, there was a $1,000 credit for installing electric vehicle chargers in your home. That is set to expire almost a year from now. So after June 30th of 2026, that will no longer be available. So if you have plans to purchase any of those things, it's important to keep your mind on these deadlines.
And then maybe last one, Tim, for all of our horse track winnings and losses, how's that going to work going forward?
Yeah, it's a shame. Yeah, you can only deduct, deductions are capped at 90% of winnings. So yeah, for all us degenerate gamblers out there, that's,
Yeah.
We're
talking taxes. We've got to have some fun somewhere in here with some funny provisions.
Right.
So if you're a professional gambler, this was not a great bill for you, unfortunately.
Yeah. At least 10% of your winnings are going to be taxed.
So. Yep.
Yeah. Well, as we wrap up, Adam, we've heard from you quite a bit on taxes. Any overall takeaways or things that you would want to leave our viewers with?
Yeah, I think you like you already mentioned, taxes and tax filing are going to become a bit more complicated because there are so many phase outs and deadlines and just different qualifications for a lot of these provisions. But honestly, our team gets excited about that because it just means there's a lot of opportunity to help clients find tax savings where they may not have existed before. And we just really enjoy tax planning and all the nuances and just new ways to look at it. So, if you haven't, if you think you might qualify for some of these things or you have questions about it, I would just, suggest reaching out to your client service team. And, we're already working on, different tax planning or projections for clients to see how this might impact their situation this year. And really, when we think about the Social Security Fairness Act, which went into effect earlier this year, and clients seeing increases in Social Security benefits or back pay or things like that, there's a lot of moving parts related to taxes this year, and we want to be very mindful of that. So yeah, I think just the important part is just make sure you communicate with us, and we're happy to help.
Yep. And if I can also put a plug in, if you haven't provided us with your tax returns from last year yet, go ahead and do that because that's a key input for us to be able to generate tax planning scenarios and compare some of these things. So please, we've asked for them, send them our way. Tim, thinking about the impact of this bill and investments and, kind of what we're looking at for this year and in the next few years, what thoughts would you want to leave our viewers with?
Yep, I think short term, this is generally a good thing. So over the next 6 to 12 months, I think that'll be additive to the economy. We should help stimulate things. There's also a lot of uncertainty out there as it relates to tariff policy and trade policy for the United States. So that's something that could counterbalance some of the benefits of this. But in my mind, we've already seen a lot of the benefits of this new tax bill priced into markets as we've seen this recent rally that's really surged since April. So over the short term, generally a good thing. Over the long term, that remains to be seen as it relates to deficit spending of the federal government, how that adds to the U.S. public debt over time, and how that debt is perceived, and the fiscal health of the United States is perceived over time by investors abroad, whether it's sovereign nations purchasing, U.S. treasuries and what have you, and just the United States as a whole. So it's kind of a mixed bag, I would say, in my mind. Short term, I think this is a positive thing for the economy. It will be stimulative. But over the long run, I do have my concerns. And that's something, Jarrod, you and I have talked about ad nauseum in these webinars, month after month, our concerns as it relates to deficit spending and how untenable and unsustainable that is. So that's something, obviously, we have to keep an eye on over the years. So,
Yep, absolutely. Awesome. Well, thanks to both of our experts here for joining us today. Hopefully you got some good stuff out of this. We'll be back again with another one next month, but if you have requests for things for us to talk about or discuss or review, we're always open to those. So thanks so much for giving us some of your valuable time, and we'll see you all soon.
thank you, everybody.
Thanks.